Hey everyone, welcome back to Corporate Decoder, the place where we attempt to make sense of the endless corporate jargon. And today we're diving into Elastic's latest quarterly report with a twist. It looks like they're trying to convince us they're totally fine while their numbers tell a slightly different story. Ready to decode? Elastic, the company behind that search and AI platform you've probably heard of, just dropped their Q1 results for the fiscal year 2026. Now, right off the bat, they're telling us they've filed all their reports, and importantly, they're not a shell company, which is good news for investors. Let's jump right into the balance sheet, the company's financial snapshot. Elastic has about $1.8 billion in current assets, that's money, and things they can easily turn into cash in less than a year. But notice how cash and cash equivalents, that's the actual cold hard cash, went down from 727 million to around 662 million. At the same time, their marketable securities, basically short-term investments, shot up from 669 million to 837 million to around 6620 million. At the same time, their marketable securities, basically short-term investments, shot up from 669 million to around 662 million. At the same time, their marketable securities, basically short-term investments, shot up from 679 million to around maybe trying to get a better return or maybe just managing their cash flow. Their accounts receivable, the money customers owe them, also took a pretty big hit, dropping from 375 million to 221 million. This could mean they collected a lot of outstanding payments, which is great, or it could indicate a slowdown in new sales. We'll have to keep an eye on that. Now, on the other side of the balance sheet, their total liabilities are sitting at around $1.5 billion. A big chunk of that is deferred revenue, which is basically money they received from customers for services they haven't delivered yet. This is usually a good sign showing future business, but it also decreased from 802 million to 710 million. Less deferred revenue might mean fewer long-term contracts or customers paying up front. And then there's shareholder equity, which is essentially the company's net worth. It went up from 927 million to 971 million. This increase is largely thanks to an increase in additional paid-in capital, which means they likely issued more stock, either through employee stock options or other share-based payments. All right, let's talk about how they actually made money and what it cost them. This is where the story really starts to get interesting. Elastic brought in a total of $415 million in revenue for the 3 months ending July 31, 2025. That's a pretty solid increase, about 20% higher than the same period last year when they made $347 million. Most of this revenue, a whopping 94%, comes from subscriptions. They've reported $388 million from subscriptions, up from $323 million last year. This is their bread and butter, and it's growing nicely. They specifically mentioned that annual Elastic Cloud revenue grew by 31%. That's a key driver for them. Their services revenue, which includes things like consulting and training, is much smaller, bringing in just $26 million. It did grow by 13%, but it's a tiny part of the overall picture. Now, the cost to generate that revenue, their cost of revenue, also went up. It increased by 5% to about $96 million. But here's the kicker. The cost of subscription revenue only went up 2%, while the cost of services revenue jumped 17%. So even though total revenue is up, the cost of delivering those services is eating into their profits. This led to a gross profit of $318 million, a really healthy 25% increase year over year, and their total gross margin improved to 77% from 74%. That sounds great, right? But dig a little deeper. Their subscription gross margin actually improved to 82%, which is fantastic. However, their services gross margin turned negative, sitting at a dismal negative 2%. Last year, it was only 1%. Imagine selling a service and losing money on every single one. That's not a sustainable business model, and it suggests they're either underpricing their services or their costs are way out of sync. Now let's look at their spending to grow and innovate. Research and development expenses jumped 22% to $109 million. They are definitely investing in new features and improving their platform, which is crucial in the tech world with AI being such a big focus now. And sales and marketing expenses also climbed up 11% to $117.4 million. They're spending more on their sales teams, commissions, and marketing efforts to bring in new customers and keep existing ones happy. General and administrative costs, the overhead for running the company, went up a modest 5% to $44 million. But here's the big problem with all this increased spending on R&D and sales. Their operating expenses outpaced their revenue growth. This resulted in an operating loss of $9 million. Now, that might not sound like a lot, but remember last year for the same period, they had a much bigger operating loss of $33 million is a red flag. Thankfully, they have some other income, mostly from interest on their investments. This helped offset some of the operating loss. But ultimately, even with that other income, the company posted a net loss of $24 million for the quarter. That's a lot better than the $49 million loss they had last year, but it's still a loss. They're burning through cash to operate. One significant factor impacting their costs and potentially masking some operational issues is stock-based compensation. This is money they pay employees in the form of company stock. For the quarter, it was a massive $69 million. That's nearly 18% of their total revenue. While it's a common practice, such a high percentage can distort the picture of their core business profitability. Let's loop back to the balance sheet, specifically to their investments. Their marketable securities total over $832 million. They've broken this down by fair value levels. Most of their investments are in level 2 assets, meaning their ECTL is determined by observable market data but not direct quotes. This means they're not holding super risky, hard to value assets, which is good. They've invested heavily in corporate debt securities and certificates of deposit. That's a pretty conservative investment strategy. In a bit of news from May, they acquired a company called Paladin Data Inc. for about $11 million. They're saying this acquisition will enhance their AI-powered solutions. We'll have to see if this expensive acquisition actually pays off. This acquisition also added about $6.6 million in goodwill to their balance sheet. Goodwill is basically the premium they paid over the fair value of the acquired company's assets. It's meant to represent things like brand value or customer relationships. Elastic now has over $326 million in goodwill, which is quite a bit relative to their revenue. This means they're betting heavily on these acquisitions driving future growth. Let's touch on how their equity changed. They saw an increase in ordinary shares from employees exercising stock options. This is typical as employees get options and decide to buy the actual shares. The big number here again is stock-based compensation, which added nearly $70 million to their equity. This is a significant non-cash expense that's essentially giving away ownership to employees. And of course, the net loss of $24 million is directly subtracted from their equity. Now let's look at cash. Generating cash is the ultimate goal for any business. For the quarter, Elastic generated $104 million in cash from its operating activities. This is a big jump from the $52 million they generated last year. This looks good on the surface, but remember, a large chunk of this is due to a huge decrease in accounts receivable. They essentially collected a lot of money that customers owed them this short term, but it might not be sustainable if it's just a one-time collection push. However, their investing activities used up a significant amount of cash, nearly $170 million. Most of this went into buying marketable securities, and they also had some business acquisitions. It seems they are actively deploying capital into investments and acquisitions. They also had a little bit of cash come in from financing activities, mostly from employees exercising stock options. Now for a bit of drama. There's a shareholder lawsuit going on regarding alleged misleading statements between May of last year and August of this year. The company says they're defending themselves vigorously. These kinds of lawsuits can be costly and distracting, so we'll keep an eye on this. The company also mentioned some other legal claims in the ordinary course of business, but they believe none of them will materially impact them. They also state there have been no material changes to their risk factors. This means the existing risks they've disclosed in previous reports are still in play. We've talked about this before. The tech industry is always facing risks from competition and changing market demands, and Elastic is no exception. There's also a disclosure about their chief legal officer and chief financial officer adopting what are called Rule 10b5-1 trading arrangements. Basically, these are pre-planned sales of company stock. It's a way for executives to sell shares without facing accusations of insider trading. Their CFO, Navam Walahinda, is planning to sell up to over 17,000 shares, and their chief legal officer, Carolyn Herzog, is planning to sell over 27,000 shares, and their chief legal officer, Carolyn Herzog, is planning to sell over 27,000 shares. This signals that maybe some of their leadership thinks the stock price is a bit high, or they want to diversify their personal holdings. It's not necessarily bad, but it's something to note. And finally, they've included all the necessary legal exhibits and certifications, including those required by the Sarbanes-Oxley Act, confirming that their leadership believes the financial reporting is sound. So what's the verdict on Elastic? On one hand, revenue is growing nicely, and they're cutting down on their overall operating loss. Their subscription business is showing strength, and they're making strategic investments in new technology and acquisitions. However, the negative gross margin on their services business is a serious concern. It's like selling a product where the cost to deliver it is more than you earn. Plus, while they managed to generate positive operating cash flow this quarter, it was largely due to collecting money owed from customers, which might not continue at the same pace. The high amount of goodwill also suggests a reliance on acquisitions that need to prove their worth. Elastic is in a competitive market, and while their core subscription product seems to be performing well, they need to address the profitability issues in their services segment and ensure their investments translate into real, sustainable growth without relying too heavily on stock-based compensation to offset operational losses. What's your take on these numbers and what they signal for Elastic's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions and insights. Thanks for watching. See you next time.